Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions and form your own financial conclusions and make your own financial decisions. Today is Wednesday, June 29th, 2022, and this is Blockhead Traders Weekly. In this week's episode of Blockhead Traders, I am all by myself, Sprocket 888, and I'm going to take a look at a new strategy I am considering deploying, and I'm going to talk you through some of the thinking. I still have to do a little more research on it and a little more digesting about what it is. However, before we hop to this week's content, I want to give a shout out to our Discord, link in the description below. Free to join. Please hop in there, say hello to myself, other Blockhead traders. Let us know what you're trading. Let us know what you'd like to hear about on this channel, and love to hear from you. So let's hop to this week's content. I'd like to kind of cover a new strategy that I came across in reading different blogs and people's trades and things like that. I started thinking about a particular trade to buy an option. Now, if you'll know, that's a little bit abnormal for me. A lot of everything that I center around is selling options. Now, I've bought a few to support things like a poor man's covered call and things of that nature. And this trade, I've looked at a couple of different tickers and I haven't executed on this yet, but I wanted to kind of talk you through some of my thinking and let you know, what piques my curiosity here and when I might deploy this. So effectively, the strategy that I'm looking at is a lot of people like to buy options. They buy call options because it is a low cost way to really kind of get a lot of leverage. It limits your downside risk when you actually buy options. The maximum amount of money that you're going to lose is right there up front when you buy the option. And that's because that option, once you own it, it's yours to decide what you're going to do with it. It can go to absolutely zero, but it's never going to cost you more money than when you put in when you purchase it. And so a lot of times when you buy options, when you get really far out of the money, that is where the option gets kind of cheaper because the probability of reaching that strike is less. So there's less premium in that strike. And so a lot of times when people want to buy something cheap, they go out really far on the strike, which has a low probability, but it doesn't cost them that much money. The drawback is it does cost you some money and you're likely to lose it all if you don't reach that strike. Now, the upside is, there's really no limit to the amount of profit that you can get when you buy a call option because you're limited only by the upper bounds of the stock, which has no upper bounds limit. And I wanted to kind of think about the current market that we're in right now, where, we've been falling week after week after week. There's lots of bad news. There's lots of panic out there. And, we might be starting to approach a bottom. We might not. But one of the things that happens when the rains come and the storms are out there is the risk to the downside is higher. And so when you look at the option premium pricing and things like that, there is more premium on the downside. So the premiums become inflated on the put side and the call costs become less because there's less risk to the upside. The market sees most of the risk to the downside. And I thought, well, is there a way that I might be able to capitalize on this? The idea being, if I'm really a believer that we're starting to bottom or we've really taken a whack off of, the downfall and we could trade sideways from here or things like that, what if I go really far out in time? Now, if you've listened to things that we've said in the past, one of the things that we always said is that when we sell options, we like to sell them around a 30 to 45 days to expiration, because that's really when theta decay starts to pick up the fastest. And theta is that time premium that's baked into the price of the option. In the poor man's covered call strategy, you'll typically buy a call that is very far out to expiration, and that effectively makes you long those shares. And the reason you do that really far out is because the theta decay is much slower the longer the days to expiration. And then you will sell shorter dated calls against that. because you're effectively long the position by owning that long call, and you can sell shorter dated calls, which are going to decay faster in theta, and you're secured in your trade because you have that longer dated call option in your portfolio. And so this is a similar concept where we want to buy a call that's very far out of the money. Sorry, it's a very far away from expiration. And so we're looking out at, a year and a half, just something really far out in the future where we want to buy that call. However, to work down the cost of buying that call, I am proposing looking at selling a put. So you're effectively financing that call by selling a high probability trade of a naked put. So the best way I can say that we should look at this is, let's pull up an example. And the first example ticker that I want to look at is Amazon. And if we pull up Amazon's chart, you can see that we are significantly off of the all-time high, or at least the 52-week high of 188.65. We recently hit a 52-week low of 101.26. So we're $80 off the high. And if you look at this chart, you're pretty steady around here, maybe 160 to 175 range. And so you might think, hey, Amazon is really depressed, but, in the long term, I really think they're going to start to bottom here. They might go down a little bit more, but, a year from now, a year and a half from now, I think they'll easily be back above 160. So you might say, hey, let's take advantage of this and let's look at the option prices around that 160 strike to buy that call that's really far out there. So for demonstration purposes, let's call out 160 as a strike. Pretty confident Amazon's going to be above $160 a share a year from now. Let's give it a year. We're going to go through some turbulent times, but you know what? People are going to realize that Amazon shopping is still there. The cloud business, the IT infrastructure, it's going to be a thing a year from now. And I really think that they're going to return to that previous value of, say, $160 a share. And so if we look at the option chain and we jump out a year, so this is the 16th of June, 2023, we come down to the 160 strike, and you can see there's a 20% chance right now that Amazon is going to reach up there. Now, part of that odds and that probability there are because the market is really raining, really fearful right now, and so there's a lot of negativity. So, the delta on that kind of strike is kind of lower. So let's go ahead and let's say we're going to buy this 160 call. It's going to cost us $4.05, which is, $405 out of our pocket. But I don't really want to enter a possibility of having 100% loss of all of my capital. And so I want to try to finance this by selling a put. And the reason I want to sell a put is because we've already fallen a lot. Volatility is elevated. There's a lot of risk to the downside. So there's a lot of premium on the downside. And so, I'll take a typical high probability trade of, my 30 delta, 25 delta strike. Let's keep it the same expiration and let's kind of go up and see what we can find. So right here, I can come down to a 25 delta. So let's take it down to $90 and let's go ahead and sell that $90 put. All right, now we have an option spread here. And guess what? That call is no longer costing me $4 or $405. I'm collecting $395. So let's go ahead and take a look at my profit and loss potential graph. You can see here I've set the gray area, which is my one standard deviation move, to June expiration of 2023. You can see right here is the current strike, and you can see the probability of landing on these aspects. So if we drop this down to my break even and I slide this over, it doesn't really matter where this one's at, but effectively you can see, I've got a 40% chance of kind of losing some money according to the odds here of the option chain. However, my thesis is that Amazon is probably going to bottom sometime between now and the next few months. Doesn't really matter when, don't know how low it's going to go, but about a year from now, I'm expecting it to be up into the $160 range. And you can see if we actually get to that $160 or exceed it, this is where my profit potential goes just infinitely up. And who knows how far it's going to go. The key point is if it doesn't make it to this 160 strike, I'm still going to walk home with $395. The only time that I'm not going to walk home with any money is if Amazon drops below that $90 or $86 break even price that I have and stays there by June of next year. And if we just kind of refresh, what we were seeing on the chart there, you can see the $80, $86 break even were quite a bit below where we are now. So effectively, what I'm doing is while the market is pushing down and crashing and dropping lower, and the more and more market participants see risk to the downside, the premiums are increasing on the downside. And if I go ahead and take a high probability trade going far out to, the 30 delta, the 25 delta, and selling that put, which is kind of my normal strategy that I like to deploy. But I think if the market is turning around, I want to catch some of that wave in the uptrend, and I want to maybe not cap my profit potential. I want to take some of that premium that I'm selling and then turn around and pay for that to buy a long call, which brings me to this chart here. And the nice thing is that as we charge up towards that strike, we are not only, this purple line is basically the value of the options today. The blue line is the value of the options at expiration. And so as we approach that 160 strike, this put that I sold will dramatically drop off value to zero, where I can probably buy it back for pennies, closing out my downside risk. And this is going to ramp up in value because there's still a ton of theta, and that just doesn't come off that quickly. And so as we charge up to that strike, when there's still a lot of theta left, the premium in that option is very thick. It's very full because I bought it when it was farther out in probability. And so I should be able to take this trade on a charge up or a rally up to that strike and close it out for a decent profit because the theta is not really going to burn off of that long call option very quickly. So another ticker I just thought I'd take a quick look at is Apple. I tend to like this strategy a little bit more with the more solid underlyings, the more kind of blue chips, the tried and the true, because they're a little less speculative on their growth or where they're going to stay. They're a little more stable in how they move. And so that reversion to those previous levels, I feel a little bit more confident in than a smaller volume, smaller position, smaller company underlying, which really could bounce around a lot more. So Apple is one of those kind of stable blue chips that I like to look at. And if we go ahead and look at Apple here and we take a look at the chart first, switching over to the Apple chart, you can see, we have the high of about $183 back here. We've gotten down to a 52-week low of around $130. So let's take my thesis on Apple. That is really going to be that up and to the right, which basically means if you look really wide time frame on this thing, hey, we've got a top here at 182. We rejected again around this 180 level. Let's just shoot for that 180 strike. And so if we kind of come over here to the option chain, we go ahead and we look at about 180. It's about a 26 delta. Let's go ahead and buy one of those 180 strikes. It's going to cost us $605 to pick up that strike 1 year from now. And if we come out here and we really think Apple's kind of, hey, long term, it's going to go up. There could be some near term pain. Tech still got some growing things to go through, but maybe I'm pretty comfortable with 129 was the 30 or 52 week low most recently, but it wasn't that long ago. We could dip down there, so you might want to back down a strike from that 130. You might be looking at this 125, that's a 30 delta. You could stretch it down to the 26 delta if you'd like. Maybe sell this 120 strike. And if I go ahead and throw that in there, all of a sudden now we went from spending the $605 to now collecting $322. And if we jump over to the profit and loss chart, we can see I've got this set to June 23rd. So this is our one standard deviation move. You can see this purple line is the value of the options today. The blue line is the value at expiration. And just like the Amazon chart, you can see, hey, we are pretty safe. This is where Apple is currently trading at around 140. We're pretty safe to make profit all the way down to about $116. If our thesis is Apple's going back up and we start charging at this 180 strike or even exceeding it, you can see that that theta is not burning away very fast. And so as we approach there, the premium in that option is just going to ramp up and increase and inflate because you're getting close to that strike. You still have a ton of time premium. And so this seems like a very compelling strategy to me, where I really think we're on the lower end of a particular cycle. Let's try to leverage that into the trading thesis. Well, that brings us to the end of this week's episode. I really just wanted to kind of run through some thinking about a particular play type that I've been considering. I have not engaged this. Really curious to hear what you guys might think about this, what your thoughts are on it. I'm going to probably post this in the Discord to get some other traders' opinions on it. Have they done things like this? I know buying options is a very, very popular strategy. I do not typically like it because it is a low probability to victory strategy. However, the nice benefit is it has a lot of unlimited upside, which is why I think a lot of people like to play it, because when you win, you can win really big. And I'm trying to experiment on if I can mix some of my higher probability trades that are very stable, very tried and true, and use some of those proceeds to maybe throw in for that lottery ticket here and there on particular underlyings when you're in particular situations, like I believe we are right now in the current market conditions. And so I'm going to look at these large blue chip tickers to see if maybe this particular strategy is something I engage on in the near future. Of course, if I do, I will absolutely let the Discord know about it. We will follow the trade here. I also post all of my trades on thetagang.com/sprocket888. You can check them out there, the good, the bad, and the ugly. Good luck out there this week. It is a very choppy and volatile market. However, that is ripe for premium selling. So good luck and have a great week. And remember, think outside the block.